Welcome back, everybody. Happy New Year. This is the first Macro Money of 2024. I'm Ilya Spivak, head of Global Macro here at tastylive. And today we begin our conversation about this abridged yet action-packed week for financial markets as January gets underway. Just 4 days of market action this week because, of course, everybody was off for the holiday on Monday. And yet it is a week that is absolutely loaded on the economic event risk front. Every single day, something weighty, every single day, something of substance to drive the story that has been so potent in markets over the past several years. And of course, emphatically so in the last 2 months of 2023, when stocks and bonds roared higher around the idea that the Fed was getting ready to cut interest rates with gusto in 2024. So what we'll start here with is a look at what the markets did in this first opening session of the new year, what it looks like, and what signaling there seems to be occurring there about where investors' head is at as they now come into this new year before the first big batch of event risk falls on investors' heads tomorrow. And as ever, when we are looking at all of this, the key question on our minds, and certainly on my mind here, is, are we likely to see any of these data points offer any sort of material change? And if they're not, is that still market moving in and of itself? Are the markets going to find in this data something to change their mind? Or are they going to find that they themselves are somewhat out on a limb, given that nothing seems to be changing? And as we can surely surmise from the title on the screen here, the first steps for markets here, not the most confident as the new year gets underway. Here's how the key markets have performed in this opening session. S&P down about 0.7% last I checked. NASDAQ down 1.7%. So stocks lower, and the weakness seemingly pointed at the riskier side of the equities spectrum, and the side where the cash is a little bit richer, and the companies are a little bit bigger, a little bit less interest rate sensitive. We don't have the Dow here, but it's actually managing to hold up flat for the day. That, of course, is an even more heavily skewed concentration on the blue chip side of things. All of those things doing better, the riskier side, the more interest rate sensitive side doing worse, which really seems to comport with significantly higher rates. The 10-year rate up 1.5%, the 2-year up 1.8%, nearly 2%. So we're looking at a situation here that seems to almost look like the mirror image of what we saw in markets in the last 2 months of last year, right down to a stronger dollar, which we see here with a euro that's down almost 1%. The euro is the most liquid counter currency for the U.S. dollar. In fact, the euro to U.S. dollar exchange rate is probably the most liquid financial instrument, period, if we consider the latest numbers from the Bank of International Settlements on the turnover numbers for the top currencies, where the dollar is still overwhelmingly the largest. Crude oil, interestingly, down, despite a little bit of geopolitical jittering earlier in the day. There were some news that Iran sent a warship into the Red Sea that nicely comports with Israel pulling back some forces out of Gaza and the U.S. pulling back some of its forces out of the region, seemingly to suggest that Iran is showing up at a time when the conflict is actually receding, not accelerating, and that this move is maybe more so geared toward filling a vacuum and having a presence than it is to escalation. And the market seemed to have read it accordingly. They're clearly not running away, suggesting that there's going to be more of a disruption from the key oil transit hubs in this area, and see more so to put crude oil into the risky asset bucket here. So it's down with stocks as rates are up. So, and it's a similar story with gold here. Gold, a little bit better, down a little bit less, nearly flat here, but nevertheless not making hay of the geopolitics and instead losing its footing as the dollar is stronger, as yields are higher. And so, as we were saying, this seems to be a clear push in the opposite direction of everything that we've seen in markets in the past 2-3 months. And here you can see in the gray bars is the outlook for interest rate cuts for this year. So the spread in rates as they're baked into Fed funds futures between January and December of 2024. And you can see here very clearly that as rate cut expectations build, so the spread gets more and more negative, implying that December is going to be lower than January by a bigger amount, so more cuts. As that is occurring, stocks are rallying. And we can see now, as it seems like the outlook for rate cuts stabilizes, so too the rally in stocks seems to have found some kind of a sticking point, and we've started to roll over a little bit. It's a similar story for the dollar, where with rate cuts came a violent sell-off in the dollar, and with those rate cuts stabilizing a bit today, with yields coming in a bit higher and bonds coming down a little bit, the dollar has found its footing and seems to have popped somewhat. Now, the impetus behind all of these moves, the sharp rise in stocks, the sharp decline in the dollar, is, of course, as we've just mentioned, the emphatic upswell in Fed rate cut expectations in the fourth quarter. And this is really the first and arguably most significant bit of update that comes to us over the next day here. The first focal point on the calendar is the release of minutes from December's FOMC meeting. And clearly, we can see the markets very much embraced that meeting as the telltale rallies in stocks and sell-off in the dollar in December will show. However, as we look at the way that the policy outlook has evolved here, we can see that the lion's share of the dovish adjustment actually occurred after the November meeting. And the adjustment after December, it was fairly modest. So here's where the policy outlook stood in November. By the December FOMC, you can see the lion's share of the dovish adjustment was already made. The curve had already flattened significantly to give much steeper rate cuts. And then since December, and this is the current curve today, there's been a little bit more of a dovish adjustment, but very modestly so. And so the question naturally is, okay, well then, what are these minutes going to show from this December meeting that we don't know already? Well, one might argue that there wasn't much that the December policy announcement itself showed, yet there was clearly an emphatic rally in stocks that still continued, and an emphatic rally in bonds that still continued, and dollar weakness that still continued. So at least for December, the markets weren't really perturbed with a lack of novelty. They were just happy that the rate cuts were coming. But as we look at the timing and the seasonality of it and the performance that we see in markets today, it does kind of beg the question. Perhaps it was that toward the end of last year, the December meeting was just seen as confirmation of what occurred in November. And perhaps the proximity of the year end itself meant that nothing new was likely to find follow through. And the markets really just got a green light from the Fed in December to keep doing what it is that they'd been doing since the beginning of November. Perhaps November's emphatic policy announcement was enough of a contrast with the prior bias and a much more acute, more overt contrast that most of the move could happen then, and December was just confirming that what occurred in that November adjustment was in fact what the Fed had in mind. And we can see that here. September was clearly a month of hawkish surprise. That was the higher for longer signaling from the Fed. And we can see that as the markets try to wrestle with the idea of what that means, what is longer in higher for longer, there is greater uncertainty in the rates outlook, the term premium jumps, and so long and bond yields rise. As the markets go, well, we don't know where rates are going over a longer term. Let's build in more of a premium on lending over longer periods of time. We need to be compensated for this greater uncertainty. So put that in the yield. And so you see the term premium widens, the 10-year rises with it. Here's the Fed's November announcement, where it basically bookends the rate hike cycle, just not quite in as clear and as transparent of a way as it did in December. And we can see the front end starts to fall, so the green line starts to decline. The long end starts to decline. The term premium starts to deflate and is now becoming increasingly negative again, suggesting that we are again seeing more confidence and less uncertainty about lending over a longer period of time, implying a greater level of comfort with where Fed policy is going more generally. So maybe it was December confirming this adjustment that clearly started with the Fed's November meeting. And that's why the markets were happy to run with it. But where we end up now, perhaps that appetite with a new year in front of us is somewhat diminished, as today's performance might imply. And it wouldn't be unreasonable if it were, because the outlook now baked into these markets is very assertive, to say the least. So we can see here, the markets are pricing in an 89% chance that the first 25 basis point rate cut is coming already in March. It's very confident that we're going to get a second cut by May. The probability of one is 88%, that there is a second cut coming. They're very confident, and similarly so, in a third cut for June. again in July, again in September, again in November, such that by the time we get to December, we're looking at 6 cuts already in the outlook. Now, this naturally raises an important question. If these minutes that are coming out are not going to break any new ground, if they're going to be echoing this kind of confirmation tone rather than new narrative update, as the December meeting itself seemed to do, how many more rate cuts is there to price in? Well, ostensibly, maybe none. If the Fed is a little bit more measured in its presentation, maybe 6 starts looking like over speculation. But of course, the key question is how the economy is doing. Does the economy actually need 6 cuts? The Fed, for its part, forecasted that we're going to get 3 this year. But of course, that's a moving target. They're going to update this again in March. We'll see what they say. But as it stands at the moment, it is a very important question for markets to ask, is the economy so weak that we need 6 cuts? And if so, is that a good thing for stocks? And on the other hand, maybe the economy is not so weak, and then we don't need 6 cuts. And is that good for stocks? Well, stocks have been running up for 2 months on the idea that 6 cuts are coming. And so, on the one hand, if these minutes don't break any new ground, and it seems like the Fed is less ready to pull out all the stops and cut with abandon than the markets seem to suggest, well, maybe that's a dampening effect. And maybe there is some follow-through on these retracement moves that we saw here today. Likewise, if for some reason there is some sort of a narrative amplifying force within these minutes, is that good news? Should stocks really celebrate an economy that needs 6 or maybe even more cuts? Or is that telling us that some sort of truly aggressive economic downturn is now in the cards, at least as far as the markets are concerned? On this front, we are going to get some further clarity because in addition to these minutes, we're going to have the release of the Institute of Supply Management's manufacturing PMI data, as well as the job vacancies numbers within the JOLTS report. And this is going to be for November. Looking at the ISM numbers, and we're going to get the manufacturing part tomorrow and the service sector part later in the week, the expectation is fairly modest. We're looking at the 13th consecutive month in contraction territory. As always, ISMs work on the same logic as PMIs elsewhere. So 50 is the center line, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What we've been seeing here really since the beginning of last year is a story that's fairly stable. The service sector continues to grow, but at a low rate. So here was the sort of emphatic catch-up growth following the reopening from COVID. That has since cooled. And from about the beginning of last year, we have had gentle sideways growth at a low level in the service sector. That, of course, comports with a similar story economy-wide because the service sector is 80% of the U.S. economy. Manufacturing is about 19%, and agriculture is 1%. On the manufacturing side, we've been in contraction mode this entire time, that services has been idling here at low growth. We're expecting more of the same and within the recent range, albeit at a slightly slower rate, so that the number is going to be a little bit higher above 40, that it's going to rise here a little bit. That is telling us that the pace of contraction has slowed somewhat. But as we can see here, only modestly so, and not really in any kind of a game-changing way. So it was 46.7 in November. It's pegged at 47.2 in December. Not really the most dramatic change. The overall setup here still pointing to slow and steady as the setting for the U.S. economy. It's a similar story if we look at what's going on with this JOLTS report. Job openings seen rising just a hair here from 8.7 million, which was a 32-month low in October, to 8.9, still very much within the context of this slow deceleration from the peaks in 2022, where post-COVID job openings absolutely surged, hitting a high of 12 million. The change here month on month, again, nothing emphatic, nothing dramatic, nothing that seems like it's going to change the Fed's calculus or the market's perception of that calculus in any sort of a meaningful way. As a matter of fact, if we look at the way that U.S. economic data has performed relative to forecasts, what we see is that it's increasingly narrowed in on expectations. Since about the middle of August, this is data from Citigroup, of course, we can see that U.S. economic data outcomes still tending to narrowly beat forecasts and that the index is above zero, but the margin by which they're beating has steadily eroded. And this index is getting closer and closer to that zero line, implying that what we're seeing is a sort of convergence of how the economy is expected to be doing and what it's actually showing that it's doing in the data. And you can see that this adjustment lined up with what we're seeing with the way that expectations have evolved. So just about from the middle of August, we can see the outlook for U.S. economic growth, in particular in 2024, was meaningfully revised higher. As those revisions came in, it became more difficult for the data to beat because the baseline, the yardstick, as it were, has been increased. And so what we see is a sort of coming together of expectations and reality that seem to be suggesting that whatever this ISM data is going to do, whatever the JOLTS data is going to do, it's probably going to register somewhere close to expectations. The stage doesn't seem set for emphatic surprises higher or lower. Now, that doesn't mean, of course, that they couldn't occur. They certainly could. But the path of least resistance seems to be toward outcomes that are generally within striking distance of forecasts. And so with that in mind, again, the question becomes, all right, so the slow and steady backdrop for U.S. economic growth holds. No major changes there. The Fed has not told us anything that seems to imply that the economy is careening off the highway, as it were, though it is moving along it at a slow speed. It doesn't seem to be falling into the ditch, and the Fed doesn't seem to be worried about it as though it is. All of which seems to raise the question of how many rate cuts does it reasonably seem we need? And the risk of saying we need less than 6 if everything is status quo, appears to be asymmetrically higher than the risk of saying we need more than 6. And even if something were to occur to suggest that we need more than 6, that doesn't seem to be a good story. That seems to be saying that, well, maybe the data does surprise very much on the downside. Maybe there is something terrible that the Fed envisions. But all of that seems unlikely to be communicated, at least here and at least now, until the markets themselves have screamed at the Fed that something is terribly off by showing either a tightness in the credit space or some sort of aggressive liquidation of risky assets, none of which has occurred. So if everything is status quo, does it really make sense that we need 6 cuts? And if there isn't something that's status quo, if it is out of consensus, that out of consensus seems more likely to appear on the we need fewer versus we need more side of the rate cuts debate, as it were. And if that's the case, then this entire dynamic here looks vulnerable to further correction. Now, that doesn't mean that the trend is going to reverse. It doesn't mean that some kind of a terrible collapse is on the menu immediately. Certainly not. But what it does suggest is that without anything at all looking different, this strong rally that we've seen over the past 2 months could have room to give back more ground. And that is macro money for today. As ever, we are here right after overtime, Monday through Thursday, or Tuesday through Thursday, as it were, this week, because of the holiday closure on Monday, of course. Overtime is the show that I co-host usually with Dylan Radigan and Chris Vecchio, where we talk about where Wall Street landed at the end of a given day and what that might mean going forward. I am on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com. As a matter of fact, this very outlook is summarized there and posted already, so go check that out. And then, of course, I am opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Macro Money will be back tomorrow. Good luck out there. Until then, take care.